Welcome, everyone. Thank you for attending today's Capital Management Corporation's June webinar. We appreciate you attending today's webinar. This is Scott Davila. I am Vice President of Marketing and Client Relations here at Capital Management Corporation. Before I get started, a couple housekeeping items I wanted to pass along. First, we will be recording today's webinar, so we will put it up on the website in the next several days. You will get an email alert letting you know that the webinar is up on the website. The second housekeeping item is how to send us questions that we will address at the end of the webinar. On your toolbar, you will see a small little caret, and next to it, the word questions. And all you have to do is click on the caret. You'll get a drop-down menu. You can put your cursor into the box, type your question, and press send to us. So with that, we're going to go ahead and get started. And as always, with me today are Tim Call, President and Chief Investment Officer at Capital Management Corp., and Mark Livesay, who is Vice President and Portfolio Manager. Today's agenda is similar to our previous webinars. We will begin with Mark discussing the current economic environment. I will discuss the government policies that are being proposed in the new bill, and Tim will discuss how CMC portfolios are well positioned long-term and highlight several of our holdings. With that, I'm going to pass it along to Mark.
Thank you, Scott. The market has had no shortage of uncertainty to deal with in the last few months. Changing policies regarding tariffs and taxes, as well as increased geopolitical conflict, have all garnered investor attention since our last webcast. Today, I'll focus on stock market volatility following the so-called Liberation Day tariffs, subsequent concerns about inflation and interest rates, and the potential impact to the broader economy. Many of you will recognize this chart if you've been in client meetings. Beginning on the left side of the chart, in 1980, each gray bar represents the price return of the S&P 500 during that calendar year. In the 45 completed years in this period, the market has risen 34 times. The red dots on the bottom correspond to the largest intra-year drop in every given year. So if someone timed the market exactly incorrectly, this is how much they could have lost in that year. As you can see from the many red dots, market volatility is nothing new. In 15 of the 45 completed years on this chart, the market has had an intra-year decline of 17 or more percent, despite 75% of the years having positive returns. This year, which is on the far right, the market fell 19% from its all-time high on February 19th. And made a short-term bottom on April 8th. On April 9th, the market was up substantially due to a pause in tariff implementation to allow time for negotiations. Geopolitical tensions can often result in market volatility, as we have seen over the last few days with the Israeli and Iran conflict. It is important not to let emotions drive investment decisions during these periods. As shown with the red dots on this page, attempting to time the market can be very dangerous for investors. Next page is on consumer confidence. Only a handful of real-time economic indicators are very reliable for predicting future stock market performance. One helpful index is the University of Michigan's Consumer Sentiment Survey. When the line on this chart is on the upper half, consumers are feeling good about the economy, and when the line is on the lower portion of the chart, they're feeling more challenged. In May of this year, the reading was the third lowest of any time in the last 55 years, only eclipsed by the very high inflation of the early 1980s and June of 2022. The most recent June 2025 reading did recover nicely from May, and we believe it is likely that May was the low point for this cycle. Typically, this is excellent news for the stock market. As noted in the box on the chart, during the 12 months following consumer sentiment cycle lows, the S&P is up 24.1% on average, with each sentiment cycle low producing at least a 14.2% return over the next 12 months. On the other hand, when people feel good about the future, the next 12 months typically produces a 3.9% forward return. So you want to buy when people are feeling bad and maybe hold on to your money when people are feeling good. The lesson, once again, is to not let emotions dictate investing decisions. Next, we'll turn to tariffs, which has been a big part of the news and stock market reaction since early April. We can see the average tariff rate on U.S. imports going all the way back to the 1900s on this chart. At the turn of the 20th century, tariffs were an important part of government revenue. But since World War II, the average tariff rate has fallen meaningfully. The proposed Liberation Day tariffs surprised the market as they were much broader and much deeper than many expected. The 30% proposed tariff would have been the highest tariff rate at any point in the last 125 years. We did provide a report shortly after the initial tariffs were announced, thinking that it would be in the best interest of all countries to negotiate with the U.S. These negotiations have begun as the administration paused the implementations of tariffs until July the 9th, which was 90 days. The current proposed tariffs are also roughly half of the rate announced in early April. The U.S. has also signed a new trade deal with the United Kingdom that came out recently, although the details of that deal remain a little bit unclear. We don't know all the specifics to it, but there's a couple that are out there. The primary market concern about tariffs has been the increased import cost, and would that cause inflation to spike higher? And we're going back to our old friend, the inflation chart. So far, the data do not show an inflation increase. The May inflation report release showed only a 2.4% inflation year over year, following 2.3% in April and 2.4% in March. Over time, we will have to see if the higher tariffs lead to a large increase in prices, but there are mitigating factors that may not lead to broadly higher inflation. First, companies appear to have bought ahead during the first quarter in anticipation of tariffs in April. We can see this from the first quarter GDP report that had a spike in imports and subsequent data showing a rapid fall in imports. Secondly, in many cases, the cost of the final good to the consumer includes things such as packaging, transportation, and marketing that may not be subject to tariffs. So even if a 30% tariff increase would not lead to the total cost of the good increasing by 30%. The third thing is energy prices fell in tandem with the tariff announcement. Energy prices are represented in green in this chart and can be volatile in both directions, with energy reducing inflation many months since the peak of inflation. Energy prices can have an impact on the price of other things as well, such as plastics, that are not directly energy related. Increased energy costs also lead to higher transportation costs that may be passed on to the consumer. So when energy fell after the tariffs were announced, this did help inflation overall. Another factor is price elasticity. For those of you who have not taken a fancy economics course, this is a fancy way of saying that customers will react to higher prices by not buying an item or buying less of that item as the price increases. After years of increased inflation, many customers will not accept meaningfully higher prices from this point on. That means that some companies that either import or export goods will see tariffs reduce profit margins instead of passing along higher prices. As individual tariff deals are announced, companies may be able to source goods from places that have more favorable deals in place. And although it's way too early to determine the ultimate impact of tariffs, so far the trends on inflation have been encouraging. Next chart is the 10-year Treasury, and this only goes back about 1 year. The 10-year Treasury is an important benchmark rate. Most corporate bonds and mortgages use the 10-year Treasury as a benchmark to price the cost of funds. So if the 10-year Treasury rises, mortgage rates and the cost of money for corporations and governments will increase as well. If a person or company is spending more on interest, they don't have as much money for more productive uses. And on this chart, you can see that the level of the 10-year Treasury is roughly flat with its level from a year ago at about 4.4%. If the bond market, which is very large and very sophisticated, thought inflation was going to head back up meaningfully, it's unlikely that the 10-year Treasury rate would be at the same place as a year ago. If that was the case, bond investors would demand more interest to compensate for higher inflation in the future. In fact, the 10-year Treasury is priced at a very similar level to the overnight Fed funds rate that is directly controlled by the Federal Reserve. That rate stands at 4.25 to 4.5%. The Fed has been meeting over the last few days and will announce any potential changes to monetary policy later today at 2 o'clock, so not too long after this call. Remember that the Fed has a dual mandate to promote price stability and full employment. Recently, employment trends have remained stable, with unemployment hovering just above 4%, which is the level that economists consider full employment. We do not expect the Fed to reduce rates at this meeting coming up, but we would expect at least one rate cut by the end of the year, and that may be signaled in the press conference today at 2 p.m., but we'll be watching that closely. So next, I'm going to turn it to Scott. He's going to discuss some potential changes to government policies, particularly regarding taxes.
Thanks, Mark. Well, since April and May, the administration has been focused on getting what they call the One Big Beautiful Bill passed. It's important to know that this bill is the key legislation for implementing aspects of Treasury Secretary Bessent's 3-3-3 policy plan that is keenly focused on economic growth. His plan has been met with both optimism and skepticism. Some analysts believe that it is way too ambitious, while others see it as a necessary step towards fiscal responsibility. The first objective of the plan is cutting the budget deficit to 3% of GDP by 2028. So what does this mean? The current budget deficit is around 6.5% of GDP. So reducing that to 3% will require legitimate and significant cuts. Even before the pandemic, the annual budget deficit as a percentage of economic growth trended closer to 4 to 5%. The administration believes it can also spur 3% economic growth through bold deregulation efforts across many different sectors: financial industry, energy, healthcare, AI, and more. One of the administration's executive orders states that 10 existing regulations will be eliminated for every new regulation implemented. The goal is to reduce the burdens on businesses to increase our country's global competitiveness. The third is increasing the production of oil domestically. The U.S. is currently the world's leading oil producer, so producing around 13 million barrels a day. Increasing this total by approximately 25% would be an uptick in economic activity. It certainly remains to be seen if these goals are achievable. If they are, it could mean a stronger economy and lower rates. We've heard a lot about the bill, and the House's version of the current bill is more than 1,000 pages long. Much of the focus in the House version has been on tax cuts. The bill is now with the Senate, so we really don't know what will eventually get passed. But in its current form, it's important to look at the more prominent tax cuts, which include making the 2017 tax cuts permanent, as well as the child tax credit. Also in the bill are provisions to eliminate taxes on overtime and tips. That was a promise by the campaign. Perhaps a little bit under the radar screen is the version. In this version includes raising the standard deduction for those 65 years and older. I just read where the Senate is contemplating raising it from $4,000 to $6,000, and increasing HSA contribution limits, which will allow individuals and families to save more pre-tax dollars for medical expenses. All in all, the White House claims the current version of the bill will put an extra $5,000 in Americans' pockets, with a double-digit % decrease in their tax bills. But the bill certainly has its detractors on both sides of the aisle due to a projected increase to the annual deficit and government debt. As of last week, our national debt was approximately $36 trillion. The real problem with this number is we spent $1.1 trillion on just the interest of the debt in 2024. That's almost double the amount the government was paying 5 years ago. So we now spend more on interest payments than we do on defense. So as the bill sits with the Senate, lawmakers are grappling with how the current bill affects government entitlement programs and how it will further impact debt. The Congressional Budget Office claims the bill would add $2.5 to $3 trillion to the nation's debt over a decade. If it reaches those types of levels, interest on the nation's debt could reach $1.8 trillion by 2035. Whereas the White House sees the bill generating $1.7 trillion in mandatory savings, as well as higher revenue from tariffs and economic growth, exceeding the 1.8% growth rate the CBO projects. The bottom line is the Senate is debating policies to best deal with the high levels of government debt. But in the short term, what we do know is that Congress does need to pass legislation this summer to raise the debt ceiling. I'm now going to pass it to Tim, who's going to discuss investments as it relates to the government debt situation.
Thank you, Scott. In recent years, the Federal Reserve, China, and Japan were the largest buyers of new U.S. Treasury debt issuance. Today, they are not reinvesting all of their maturing U.S. Treasuries. As those Treasuries mature, they need to be refinanced. Who will buy those bonds and the new bonds needed to finance the current year deficit? Recent incremental buyers have included leveraged hedge funds. These are neither reliable buyers nor long-term investors. Newly issued treasuries will compete with mortgage-backed securities and corporate bonds to attract investors. While the Federal Reserve might lower interest rates later this year, long-term rates could rise as more and more government debt is issued. Corporations offer higher interest rates than the government to raise new debt and refinance maturing debts. Some corporations will have to offer much higher rates, incurring higher recurring interest expense. Stocks and bonds of firms with high debt ratios have already been severely discounted by the market. Some firms unable to generate or raise cash could be in trouble. Most publicly listed firms do not generate excess cash through their daily operations. At the other extreme are profitable firms generating lots of excess cash. We refer to these as cash cows. Quantitatively, we screen for the top 10% of cash-generating companies, those generating lots of excess cash relative to their size. These screens also prioritize growth, recurring growth. We refer to the resulting stocks as growing cash cows. Firms with a growing stream of excess cash that can pay down debt, make instantly accretive acquisitions, reinvest in their internal growth, such as research and development and capital expenditures, pay dividends, raise dividends, and repurchase their shares. Some growing cash cows have above average debt loads from prior acquisitions. Due to above average debt ratios, their stock prices are severely discounted. With the right management, heavily discounted, growing cash cows can offer strong multi-year returns. Our fundamental research and valuation disciplines can uncover special opportunities like these from various industries. This results in a concentrated yet diversified portfolio with excellent potential to reward patient investors. As these firms use some of their excess cash flow to pay down debt, their stock valuation multiples should expand. Combining this with revenue and earnings growth should yield strong compounding of long-term results. Examples include a real estate investment trust, or REIT, named Service Properties Trust, which is half hotels and half triple net lease properties. It's currently improving its hotel portfolio through renovating key hotels and divesting less profitable hotels. Over $1 billion of less profitable properties are scheduled to be sold this year. Proceeds will pay down debt. Several of its hotels have recently exited major renovations. These renovated rooms can now be put into service, earning revenue and higher daily rates and higher revenue than they were pre-renovation. These divestitures and renovations result in a higher quality and more profitable hotel division. The other half of the firm receives recurring contracted revenue increases with few corresponding expense increases. So the unit profitability of both divisions should show strong growth. When combined with debt paydown, Service Properties' financial metrics are set to drastically improve. In upcoming years, as Wall Street sees these changes in its rearview mirror, this stock's valuation multiples should expand. Other growing cash cows rapidly paying down debt include regional TV firms like Sinclair and Gray. The bears say regional TV is dead, and that is how these stocks are priced today. But the major networks are desperate for strong local news viewership, lead-ins. The lead-ins to their morning shows, primetime shows, national news, as well as late-night programming. Networks and the over-the-top or OTT apps, the TV apps, are hyper-focusing on national sporting events with the highest viewership. They need each local broadcaster to provide permission for customers to watch that programming in those local broadcasters' regions. Local broadcasters also directly sign profitable win-win agreements with local teams and regular season games. New FCC commissioners and a new chairman should decrease merger and acquisition restrictions and improve local broadcaster rights to air the national shows in their regions. Long-term local advertising growth and retransmission rights greatly support these companies' excess cash generation. When we combine this with increased merger and acquisition activity and recurring debt paydown, we should see much higher valuations. Then there are cash cows like ACCO Brands and Pitney Bowes that switched managements. And this happened after prior management wasted cash flow on investments that did not pay off as expected. Well, under new management, Pitney has tripled over the last 2 years as it retired its debt. It's already increased its dividend twice over the last year, continues to aggressively repurchase shares, continues to pay down debt, and remains a great opportunity. Shares of ACCO Brands have not yet started their rapid ascension. It's similar to Pitney in many ways. It's pared down less profitable lines, is expanding higher margin lines, such as Daytimer, Mead, Swingline, and its computer accessories and gaming accessories businesses. Computer accessories lagged in the aftermath of the COVID PC boom. But the personal computers bought during COVID have now aged. Many of those are over 5 years old. ACCO's computer accessories division will rebound with a multi-year PC replacement cycle and new PCs needed for newer technologies such as Windows 11 upgrades and increased AI, alternative intelligence usage. Gaming accessories should benefit from this month's long-awaited launch of Nintendo's Switch 2. Meanwhile, ACCO has been paying down debt. Interest expense is in rapid decline. ACCO has so much cash generation that while it continues to pay down debt, it can repurchase shares. It recently made an accretive bolt-on acquisition, and it continues to reward investors with a stable dividend, currently yielding over 8%. Results of ACCO's hard work and successful realignment should result in sales growth, followed by years of accelerating sales growth, gross margin expansion, profit margin expansion, strong earnings growth, also followed by years of accelerating earnings per share growth. Our forecast is for many of the stocks on these pages to more than double over the next 3 to 5 years. Personally, I will be disappointed with any of these 9 firms whose stocks do not triple. And along the way, we will continue discussing ideas with these companies' managements. Some oversold growing cash cows don't need to pay down debt. Concentrix continues to pay down debt between acquisitions, but another tech name, Mastech, recently became debt-free. Its cash balances have now amassed to a large percentage of its stock market capitalization. So we expect major share repurchases this year. Importantly, both of these IT firms are using cash flow to expand their product offerings and their geographic coverage. Harmony Biosciences has also paid off most of its debt. Its cash balances now exceed all of its outstanding debt. Excess cash is funding acquisitions of promising future drug candidates, the development of already owned drug candidates, and funding expensive studies that could result in eventual FDA and foreign approvals of new drugs. They're spending money on research trials to expand indications, and they're improving the formulation of their main product, which should extend the patent protection. Product growth at these firms could result in years of earnings per share growth exceeding 20% per year. Firms like these, building long track records of strong revenue and earnings growth, should be rewarded with higher valuation multiples on those higher earnings. Another 2 firms have recently paid off all of their debt. Cash balances are rapidly growing at LifeVantage and Wisdom. LifeVantage's current product launch is proving to be the most successful launch in its history. Management expectations for a strong launch were greatly exceeded. This is the first time LifeVantage has sold out of inventory. Today, inventory is back in line and the international launch is underway. Despite this product expansion and working capital growth, record cash generation continues. Management recently indicated that share buybacks appear quite attractive at current stock prices, and we expect another dividend increase before year-end. After several years of gold mine infrastructure investment, Wisdom now has volume growth. We expect years of strong growth in ounces of gold produced by their two main mines. Wisdom's growth stands out as the rest of the gold industry production is stagnant. Higher unit production will spread the fixed costs over a wider base. This lowers the cost per ounce. Meanwhile, buyers keep buying gold at higher and higher prices. China and several central banks keep raising their gold reserves. The combination of strong double-digit unit production growth, higher gold prices, and lower production costs per unit is resulting in triple-digit profit growth. Last quarter, Wisdom made a cash purchase of the mineral rights and land which was contiguous to its best mine. Despite this material purchase, cash balances still grew in the quarter. Too much cash, followed by even more cash, is a good problem to have. Historically, in aggregate, smaller companies grow at a faster rate and sport a higher valuation multiple than larger firms. Yet today, overall valuation metrics are the reverse. Our portfolio holdings undergo quantitative, fundamental, and valuation research. While they represent a wide variety of industries, their common traits are admirable. Most of our holdings are growing niche leaders within growing industries. Unlike most publicly traded firms, they internally generate excess cash. Attractive entry valuations, more attractive than the S&P 500, should enable even stronger returns. When we combine these firms, they represent broadly diversified portfolios covering most, if not all, of the economic industries. By industry standards, these portfolios are concentrated. We have less than 50 approved holdings. By concentrating on our best ideas, our select portfolios have built strong long-term track records. Dividend appreciation is an all-cap portfolio with large caps, mid caps, and small caps. It has an emphasis on companies expected to grow their dividends. Despite strong underlying growth and a 3% dividend yield, this portfolio has a PE multiple below that of the S&P 500. Our all-cap growth and income portfolios have an even higher dividend yield and lower valuation multiple. The average growth rate might be lower than in dividend appreciation. But I expect growth in income's underlying company earnings growth, dividend yield, and attractive entry valuation to compete rather well against the major market indices over the next 5 years. SMID, our small and mid-cap portfolio, has each holding, each holding is less than 10 billion in size when you look at its stock market capitalization. All of the stocks referenced today are in the SMID portfolio. SMID provides the opportunity to own fast-growing, undervalued stocks from various industries. Our portfolios concentrate on what we consider to be the best opportunities, and SMID is one of our most concentrated portfolios. SMID takes advantage of the current market-wide mispricing of mega caps versus small caps. SMID represents overlooked, undervalued stocks, well researched by your investment manager, who you personally know. These are stocks of firms with superior growth potential. This concentrated best of the best portfolio represents an attractive multi-year opportunity. So economic and market uncertainty have created some great entry opportunities. We know of some reported uncertainties. This year's uncertainty over inflation, short-term interest rates, and long-term interest rates will diminish over time. By next year, the current trends of inflation and its components will be more clear. The overnight interest rate cut by the Federal Reserve should occur before year end. And this provides assurance that the United States remains in a rate-cutting cycle. U.S. tariff negotiations are progressing for most countries. Agreements made later this year result in less trade and tariff uncertainty for next year. Only one reconciliation bill is allowed to pass Congress each fiscal year. Within months, we will know whether or not tax and spend legislation passed. The details of any past legislation will have been finalized. As the rules become known, the increased clarity enables business leaders to move forward. There will always be uncertainty on some issues, but the current uncertainty over inflation, interest rates, tariffs, and taxes should be lessened, and less uncertainty typically results in higher valuations. As the long-term recurring profitable growth of our select groups of stocks build and becomes known, better known, and more certain, we will see rising valuation multiples on growing earnings, which will reward our investments. These stock prices should eventually reflect the individual strengths of these companies. Capital management has been around for 61 years. We have a strong long-term history of stock selection and compounding results. We will continue to build on it. Our clients deserve this. Scott?
Thank you, Tim. Thank you, Mark. We are ready to take some questions. We already have a few in the queue. I'm going to start with the first one here. Will companies raise prices to offset tariff increases? How severe will it be to cause inflation to rise? Tim?
Well, some companies will raise prices and others won't. They can absorb these tariff costs. If you remember, China incurred a 20% tariff 5 years ago, and it's made the U.S. government a lot of money over 5 years. And so we've had 5 years already of that 20% tariff, and not many people remember that tariff hurting them or resulting in higher prices. We're in communication with the managements, especially of the smaller companies that we own. And one of those managements gave us a good example of, they happen to be the largest, the dominant provider of scissors, consumer scissors in the United States. They've won the #1 market share, and luckily for them, while they import these scissors from China, all of the competitors do as well. So somehow China makes all of the consumer scissors in the world. They're looking to, the company's looking to change this. But in the meantime, if they buy a pair of scissors for 70 cents, and let's assume one of the worst case scenarios that tariffs are 100%. Now, for most countries, we're talking about 10 or 20%, but to make math easy, we'll assume 100%. So right now, they're buying scissors at 70 cents. They'll sell to Walmart or Staples for $4.50. Walmart will then sell it to you for $10, and Staples will for $12. Well, a 100% tariff means instead of costing the firm 70 cents, the scissors will cost the firm $1.40. Well, this can be absorbed along the way by the company or the retailer. The company does not plan to absorb this cost, but the retailer might. What if no one absorbs this cost? What if the consumer has to pay the cost? Well, then our company will raise the price of their scissors by 70 cents, the amount of the tariff, and so will Staples and Walmart. And so when you go to Walmart, instead of paying $10 for the scissors, you'll pay $10.70. So that's not too bad. That's not, 100% tariff has then resulted in only a 7% increase in the end product price, and no one's profitability has been hurt. So we don't want to see 7% price increases. We don't expect that at all. At the same time, that's a lot better than 20% or 100%. But just wanted to go through that mathematical example because while the tariffs on these countries at 10, 20% or more are material for the federal government and generate a great deal of revenue, they don't increase the end prices by the same amount. A lot of the cost of a product is not just the basic material, it's the transportation, it's the packaging, and it's giving profits to the distribution and the retailer. And none of those incur the tariff. An old example from years ago of research is the cost of perfume. The smallest input cost for perfume is the liquid. It's the packaging and the marketing that really costs money, not the substance you're buying.
Thanks, Tim. Another question we have here. It seems that REITs have had mixed performance results over the past over the past couple of years as compared with S&P 500. Do you feel that environment is changing with core investments such as service properties, SVC?
Well, a lot of REITs have been under pressure as interest rates rose, their financing costs has risen, and their stock prices went down as a result of that. But service properties has locked in a lot of its interest costs, a lot of its debt is at fixed rates, And as that debt comes due, they plan on paying off a lot of it with cash from operations and cash from the divestiture of less profitable properties. This will leave them with more profitable properties and less debt. We think Wall Street will appreciate this, and we look forward to the higher quality portfolio resulting in long-term growth. And so we do see a change with interest rates being more stable, with long-term rates not going from 1% to 5% again. We have stability, and this company has operations that are turning around. Wall Street should eventually recognize it, and the stock will be rewarded.
Thanks, Tim. That appears to be the two questions that we received today. If we missed your question, we are hopeful to be able to get to it, and we will get back to you on an individual basis. We want to thank you again for attending today's webinar. We appreciate your attendance. As I mentioned, we have recorded this webinar. We will be posting it up on our website here in the next several days. You will receive an email alerting you that it's up there. For that, again, thank you for attending and have a great rest of the day.
Thank you.
Thank you.